Imagine waking up one morning, checking your phone, and seeing that one of the most reliable assets in human history just did something it almost never does. Gold is sitting at $4,500 an ounce. And silver is still at $74. You rub your eyes, you refresh the screen, same numbers, and somewhere in the back of your mind, a question starts forming. A question that Wall Street analysts, hedge fund managers, and everyday investors all started asking at the same time. Why? Why are gold and silver moving in completely opposite directions? These two metals have traveled together for centuries. They've been linked through wars, economic crashes, currency collapses, and every financial storm the world has ever seen. And yet right now, in the present moment, they are not just diverging. They are splitting apart in a way the market has almost never seen before. There are people who saw this coming, and there are people who didn't. The difference between those two groups will define what their financial future looks like for the next decade. By the end of this video, you are going to understand exactly what is happening, why it matters, and what the smartest money on the planet is doing about it right now. So stay with me, because this story only gets more surprising from here. Let's go back to basics for a moment, because to understand why this split is so unusual, you need to understand why gold and silver are supposed to move together in the first place. For most of modern financial history, these two metals have shared a relationship known as the gold-to-silver ratio. It's a simple concept. It tells you how many ounces of silver it takes to buy 1 ounce of gold. Historically, that ratio has averaged somewhere around 60 to 1, meaning 60 ounces of silver equals 1 ounce of gold in value. That ratio has been the financial world's way of keeping these two metals in balance. When one gets too cheap relative to the other, investors jump in to correct it. The market self-adjusts. That's how it's always worked. But right now, if you do the math, $4,500 divided by $74, you are looking at a ratio of over 60 to 1, and it has been climbing. That imbalance is not just unusual. For many analysts watching the precious metals market closely, it is a red flag, a signal, and depending on who you ask, it might even be an opportunity that comes along once in a generation. And now, if you're finding this story valuable already, and trust me, we are just getting started, go ahead and hit that like button right now. It genuinely helps this channel reach more people who need to hear what's happening in these markets. And if you haven't subscribed to John AG 1.0 yet, do it now. We cover the stories behind the numbers that most financial media buries in the fine print. All right, let's keep going. So why is this split happening? The first reason is actually hiding in plain sight, and it has to do with who's buying gold right now. Central banks. Not just one or two countries. We are talking about a coordinated global rush into gold by some of the largest central banks on the planet. China, Russia, India, Turkey, Poland, country after country has been loading up on gold reserves at a pace not seen since the early 1970s. And here's the thing about central banks. They don't buy silver. They never have, not in any significant way. Gold is the asset of governments. It's the asset of sovereignty. When a country wants to move away from the US dollar as its primary reserve currency, it doesn't buy silver bars, it buys gold. And that demand, coming from entities with essentially unlimited purchasing power, is pushing the gold price to levels that retail investors and even many institutional funds are struggling to keep up with. Silver, meanwhile, is in a completely different world. Silver's price is still largely controlled by industrial demand, mining supply, and retail investor sentiment. It doesn't have a central bank backstop. It doesn't have sovereign wealth funds buying it in the hundreds of billions. What silver does have, though, is something gold doesn't. And this is where the story takes a genuinely surprising turn. Silver is quietly becoming one of the most critical industrial metals of the 21st century. Solar panels, electric vehicles, advanced semiconductors, medical devices, all of these industries are consuming silver at a rate that's growing every single year. And here's the part that almost nobody in mainstream financial media is talking about. Silver supply is not growing fast enough to meet that demand. Mining output has been relatively flat for years. Recycling rates, while improving, are nowhere near enough to fill the gap. There is a structural supply deficit forming in the silver market, and it has been building slowly and quietly for years. Now think about what that means. You have a metal that the industrial world increasingly cannot function without, that is already trading at a historically low price relative to gold, and that is facing a supply crunch that is only going to intensify as the green energy transition accelerates, and yet the price is sitting at $74. Some analysts aren't just calling this undervalued, they're calling it one of the most mispriced assets in the global economy right now. So why hasn't silver exploded in price yet? This is the question that keeps precious metals investors up at night. And the honest answer is that silver's price is also heavily influenced by financial instruments, futures contracts, paper silver, exchange-traded products that allow enormous amounts of synthetic silver to exist on paper without any physical metal behind it. When institutional investors want silver exposure, many of them buy paper contracts, not actual silver. This keeps a lid on the physical price. But here's what's interesting. When a squeeze happens, when physical demand suddenly outpaces the paper market, silver can move in ways that are genuinely violent and fast. It happened in 2011 when silver shot from about $18 to nearly $50 in just a few months. It happened briefly in early 2021 when retail investors coordinated a massive buying surge, and those who understand the mechanics of the silver market believe the conditions for something similar are quietly being set up again, on a much larger scale. Meanwhile, gold is doing something it has never quite done before. It's becoming a geopolitical asset in real time. As nations around the world work to reduce their exposure to the US dollar, a process economists are now calling de-dollarization, gold is the alternative they are all turning to simultaneously. The dollar has been the world's reserve currency for nearly 80 years. And while no one is saying that's ending tomorrow, the pace at which countries are building up gold reserves to hedge against that possibility is accelerating. When you combine that geopolitical buying pressure with traditional inflation hedging demand and growing retail investor interest, you get a gold price that has room to keep climbing even from already historic levels. But here's where individual investors face a real and difficult choice. Gold at $4,500 an ounce is not accessible to everyone. 1 ounce of gold costs more than most Americans make in a month. The psychological barrier alone keeps many people out of that market. Silver at $74 is a completely different conversation. $100 buys you more than 1 ounce of physical silver. You can start building a real position without needing to liquidate your savings account. And if the gold to silver ratio eventually corrects back toward its historical average, which it has done every single time it has stretched this far, silver's upside potential is arguably far greater on a percentage basis than gold's from this level. Now, there is also something important happening in the options and futures markets that sophisticated traders are watching very carefully. Open interest in silver futures contracts has been rising. The number of large institutional positions betting on a silver price increase has been climbing steadily. When you combine that with the physical supply deficit, the industrial demand trajectory, and the historical tendency for the gold to silver ratio to revert to the mean, you start to understand why some of the smartest money in the room is quietly repositioning into silver, while most of the world's financial media keeps all its attention focused on gold. None of this means gold is a bad investment. Let's be absolutely clear about that. Gold is doing exactly what it's supposed to do. It is preserving wealth, hedging against currency debasement, and serving as the ultimate safe haven in an era of rising geopolitical uncertainty. If you hold gold, you are positioned correctly for what many analysts see as an increasingly unstable global financial order. But the split between gold and silver right now is telling a more complicated story than just buy precious metals. It is telling the story of two different forces pulling the market in two different directions. Government-level demand on one side, industrial and retail dynamics on the other, and the gap between them cannot hold forever. History has a long memory when it comes to these ratios, and every time the gold-to-silver ratio has stretched to extremes, in 1991, in 2003, in 2020, silver has eventually caught up. Not always quickly, not always smoothly, but the reversion has always come. The investors who understood that, who were positioned before the move, are the ones who look back on those moments as the trades that changed their financial lives. So here is where this story lands. You are watching, in real time, one of the most unusual divergences in the precious metals market in modern history. The forces behind it are real, they are structural, and they are not going away anytime soon. What happens next depends on variables that no one can predict with certainty: monetary policy, global conflict, industrial demand curves, and the behavior of central banks that don't always telegraph their intentions. But the split itself, the story of $74 silver and $4,500 gold, is a story that deserves your attention. Because the markets that seem the most boring are often the ones hiding the biggest moves. Now, before you close this video, I want to hear from you. Drop a comment below and tell me, are you in the gold camp, the silver camp, or are you watching both and waiting? Do you think silver is the most undervalued asset in the market right now, or do you think there's a reason it's where it is? Your perspective matters, and these comment sections are where the real conversations happen. And if this video opened your eyes to something you didn't fully understand before, do me a favor and share it. Send it to a friend, post it in a group, show it to someone who needs to hear this story. The more people understand what's really happening in these markets, the better decisions we all make together. This is John AG 1.0, and we'll see you in the next one.